Okay, so if you are in your early, maybe mid-20s right now, this deep dive is absolutely for you. I know that feeling. You're probably looking at your bank account, maybe juggling student loan payments, definitely splitting that super high rent with roommates.
Right.
And the whole idea of investing, it just feels like something for people who already have, money.
Like you need a pile of cash just to get in the door.
Exactly. You probably think you need 5 figures saved up first.
And that feeling, that sort of paralysis, thinking you're too broke, that's honestly the single biggest thing, stopping young people from making, well, what could be the smartest financial move of their lives.
They wait for things to feel stable.
But stability often comes, a bit too late for the magic to really happen.
That's the key insight we pulled from our sources, really. Here's the surprising part. You actually have this huge financial advantage right now, one that no amount of money can buy later on. And that advantage is simply time.
Time. It sounds so simple.
It is. We're talking about using time so effectively that starting right now, even if it's just, say, $25 or $50 a month, that could be the smartest financial decision you ever make. Potentially.
Yeah, our mission here is really to break this down, make it less intimidating. We want to show you exactly how you can start.
Right.
And, crucially, how to set things up so that compound interest, that's the power we're talking about, does most of the heavy lifting for your future wealth.
Okay.
Honestly, when you see the math, that whole I'm too broke excuse, it just kind of evaporates.
Okay, let's unpack this then. So let's start with the basics, the kind of fundamental math here. The physics of time in the money world.
Right.
Our research is super clear on this. Being consistent and just the number of years you let your money grow, that matters way, way more than how much you put in at the very beginning.
Absolutely. We looked at this really compelling case study, a recent grad we're calling Blessing.
Okay, Blessing.
So, Blessing is smart, starts investing $500 every single month, puts it in a retirement account right at age 24.
Straight out of the gate.
Yep. And assuming a pretty reasonable, maybe even conservative 7% average annual return over the long haul.
Which is historically about right, yeah.
Yeah, pretty standard assumption. By the time Blessing hits 65, that steady investment, it could grow to over $1.3 million.
Wow, $1.3 million. That sounds like, a dream number.
It does. But now, let's compare Blessing to, say, Alex. Alex also graduates but decides to wait. Waits until feeling more secure.
Which is understandable, I guess.
Totally understandable. But Alex waits until age 35 to start, puts in the exact same $500 every month consistently until 65.
Same amount, just starting later.
Right. Alex ends up with roughly half, about $680,000 by retirement.
Half, just from waiting 11 years.
Exactly. Same monthly check written, same investment type, but the outcome is drastically different. Why? Because Blessing had those extra 11 years.
All that compounding.
All that compounding. The money Blessing put in during their 20s had decades to double and then double again. It's incredible.
Okay, this is where the data gets really, really eye-opening, especially for anyone thinking, I just can't afford much right now. We can run a scenario where the person who starts earlier actually puts in less each month.
And still potentially comes out even, yeah. Look at this comparison. Scenario A starts investing at age 25, puts in just $200 a month. Modest.
Okay, $200. Manageable for many.
Scenario B starts later, age 35, but invests double that amount, $400 a month, trying to catch up.
Right. So twice the monthly contribution, but 10 years later.
And when they both hit age 65, they both end up with roughly the same amount, around $525,000.
Wait, really? The person investing $200 a month ends up the same as the one investing $400?
Because they started earlier. That person who put in half the monthly amount achieved the same result purely because they bought more time.
You weren't just buying stocks, you were buying years of growth.
That early money, it just has this, gravitational pull. It compounds for longer. If that doesn't convince you to start with maybe the cost of, 2 takeout meals a month.
Right. Then maybe nothing will. That's incredibly powerful evidence for starting now. But okay, hold on. Before anyone gets excited and jumps into an investment app, we have to talk about the foundation.
Crucial.
You can't build a strong house on, shaky ground. So what are the absolute must-dos before putting money into the market?
Yeah, this is the really critical part. Skip this and you might just be spinning your wheels, honestly.
Okay.
First, number one priority, tackle high-interest debt. If you're carrying credit card debt at, say, 18%, 20% interest, maybe even higher, that has to go first. Period.
And the logic there is?
It's simple math. No investment you make is guaranteed to beat an 18% interest rate consistently. It just isn't.
Okay.
So paying off that 18% credit card, that's basically like getting an 18% guaranteed tax-free return on that money. You won't find that return anywhere else safely.
That reframes it completely. You're not just paying down debt. You're locking in a massive guaranteed return.
Precisely. Second thing, absolutely essential, an emergency fund.
The rainy day fund.
Yep. Aim for 3 to 6 months of essential living expenses. And this money needs to be safe and accessible, usually in a high-yield savings account. Not invested.
Why not invested?
Because its purpose is purely defense. If your car dies, or you unexpectedly lose your job, or face a medical bill,
life happens.
Life happens. You absolutely do not want to be forced to sell your investments when the market is down just to cover costs. That locks in losses. The safety net. It's non-negotiable.
Got it. High interest, debt gone, emergency fund build. What's next?
The final piece is just clarity, knowing your goals.
Right.
Why are you investing? Is it for retirement way down the road, maybe 40 years from now?
Or is it something sooner?
Exactly. Or are you trying to save up for, say, a down payment on a house in 5 years, or maybe a big trip in 3?
And those need different approaches.
Drastically different strategies, yeah. Especially around how much risk you should be taking.
Perfect. Okay, foundation check. High interest debt tackled. Check. Emergency fund in place. Check. Goals loosely defined. Check.
Good starting point.
Now we've got that small, consistent monthly amount ready to go. Where should a 20-something put it first? What's the absolute top priority?
Priority number 1, without a doubt, is what we often call free money. It's your employer's 401k match, assuming you have access to one.
Ah, the company match.
Yes. If your company says, we'll match dollar for dollar up to 3% of your salary that you contribute, you have to contribute at least that 3%.
Why have to?
Because if you don't, you are literally turning down free cash from your employer. It's an immediate 100% return on your contribution right off the bat. You can't beat that.
That makes sense. I love the practical tip we found here, too. Build a habit. Every time you get a raise, even just a small cost of living bump, immediately increase your 401k contribution by 1%.
Oh, that's brilliant.
You probably won't even feel the slightly smaller paycheck, but your future self gets this huge advantage over time.
That's fantastic habit-building advice. Okay, so you're getting the full match. What's next? Priority 2.
Yeah, what's number 2?
Generally, the next best step is opening and funding a Roth IRA.
Roth IRA.
For younger investors, we almost always recommend a Roth over a traditional IRA. The main reason is taxes. You're likely in a lower tax bracket now than you will be decades from now in retirement.
So pay the taxes now while your rate is low.
Exactly. With a Roth, your contributions are made with money you've already paid taxes on, but then all the growth and all the withdrawals in retirement are completely tax-free.
That sounds pretty good. But what if someone genuinely thinks they'll be in a lower tax bracket later? Like maybe they plan to retire super early to somewhere with no income tax. Does the Roth still make sense?
That's a fair question, and it does depend on individual circumstances. If you are absolutely certain your taxable income will be significantly lower in retirement, a traditional IRA might save you more overall because you get the tax deduction now. But generally for young people, the Roth has a couple of big advantages beyond just the tax rate guess. One is tax diversification. It's really good to have different types of accounts, some tax now, some tax later. Gives you flexibility.
Don't put all your tax eggs in one basket.
Sort of, yeah. And the second big plus is flexibility. With a Roth, you can actually withdraw your original contributions. Not the earnings, just what you put in anytime. Tax-free and penalty-free.
Oh, wow. So if a real emergency hits after the emergency fund is gone.
It provides an extra layer of comfort knowing you could access those contributions if you absolutely had to. Huge peace of mind for younger people.
And the contribution limit is pretty decent too, right? For 2025, it's like $7,000 if you're under 50.
Yeah, $7,000 gives you a good target to aim for eventually. So, okay, we've got the accounts open, the 401k, getting the match, the Roth IRA being funded. Now the big question.
What you actually buy inside those accounts.
Right. And as a beginner, please avoid the temptation to try and pick the next hot stock, like the next Tesla or GameStop or whatever.
Yeah, probably good advice. So what are the simple hands-off options, the ones that don't require a finance degree?
We basically recommend 3 great autopilot options. First, target date funds.
Target date, okay.
This is probably the simplest. You just pick a fund with a year in its name that roughly matches when you think you'll retire, say target retirement 2065.
And then?
The fund manager does the rest. It automatically adjusts the mix of investments for you over time. Starts off aggressive, heavy on stocks when you're young.
Can maximize growth.
Exactly. And then gradually gets more conservative, adding more bonds as you get closer to that 2065 retirement date to protect your money.
Truly set it and forget it.
Pretty much. Second option, index funds.
Heard a lot about these.
Yeah, they're maybe a bit boring, but they are super reliable and historically very effective. An index fund just aims to track a whole market index.
Like the S&P 500.
Like the S&P 500, which holds the 500 biggest U.S. companies. Or maybe a total stock market index. The beauty is you get instant diversification across hundreds or thousands of companies.
So you're not betting on one company, but on the whole economy growing over time.
Precisely. And they usually have extremely low costs, which is key.
Okay. And the third option, you mentioned tech earlier.
Right. Robo-advisors. These are online platforms like Betterment or Wolfront.
How do they work?
You basically fill out a questionnaire about your goals, your timeline, how comfortable you are with risk.
Okay.
And then their algorithms build and manage a diversified portfolio of low-cost funds for you. It's like having professional management, but automated and usually much cheaper than hiring a traditional human advisor.
Okay, great options. Let's switch gears slightly to the habits. We've established you don't need a pile of money to start. That classic advice of saving 20% of your income, that can feel impossible.
Totally daunting for someone starting out.
So let's talk about the magic number just to get the ball rolling, just to break the seal and start.
Look, start with whatever you can genuinely, consistently afford without stressing yourself out. If that's $25 a month, fantastic. $50, amazing.
Seriously, just $25.
Seriously. Starting with $25 today is infinitely better than waiting 3 years until you think you can afford $500. Remember the compounding math.
Right. Time is the key ingredient.
And look at it this way. Investing $3,000 over a whole year sounds like a lot, right? But break it down monthly. That's only $250 a month. Suddenly seems a bit more doable, doesn't it?
Yeah, framing it like that helps. Okay, so we start small. But what's the key habit? The thing that actually makes this happen reliably?
Oh, it's simple. Automation. You have to automate it.
Everything.
Everything you can. Set up an automatic recurring transfer from your checking account to your investment account. Make it happen right after payday, before you even see that money sitting there tempting you.
The old pay yourself first principle.
It's the bedrock. You commit that money to your future self first, and then you figure out how to live on what's left. That tiny bit of friction, having to manually move the money each month, it's enough to make people skip it.
Oh, I'll do it next month.
Exactly. Eliminate that friction. Automate it.
And technology makes starting small easier than ever now, right? With things like fractional shares.
Totally. Fractional shares mean you don't need hundreds or thousands of dollars to buy one share of an expensive stock like Amazon or Google. You can buy just $5 or $10 worth if you want.
So it really lowers the barrier to entry.
Hugely. And there are tons of beginner-friendly apps and platforms now. You've got Robinhood, known for commission-free trades and fractional shares. Acorns is cool. It rounds up your purchases to the nearest dollar and invests the spare change.
Oh, that's clever.
And then the big established players like Fidelity and Vanguard, they offer great low-cost index funds, target date funds, and often have zero minimum balance requirements to open an account now.
Okay, so it's easy to start, but technology maybe also makes it easy to mess up.
Yeah, that's definitely true.
As someone gets going, maybe they start seeing some gains or maybe some losses.
Yeah.
What are the common traps or pitfalls they absolutely need to avoid?
Okay, number one mistake, classic mistake, trying to time the market.
Buying low, selling high. Sounds easy.
Sounds easy is nearly impossible to do consistently. Nobody, not even the super smart hedge fund managers, can reliably predict short-term market moves. Just accept it.
So what's the alternative?
Time in the market beats timing the market. Almost every single time over the long run. Get your money invested according to your plan, and then leave it alone. Let it ride the waves.
Okay, don't try to be a genius trader. What's next?
The next one is maybe the hardest because it's all psychological. Emotional investing.
Freaking out when things go down.
Exactly. It is absolutely lethal to your long-term returns. The news gets scary, the market drops 10 or 20%, people panic, they sell everything, locking in those losses.
And then what happens?
They usually sit on the sidelines in cash, scared, and miss the eventual rebound. Think about the COVID crash in early 2020. People who panicked and sold missed a massive recovery.
Whereas those who stuck to their plan or even bought more,
they were rewarded handsomely. You have to have a plan and stick to it, especially through the scary times. Don't let fear drive your decisions.
Makes sense. You mentioned index funds help with diversification.
Yeah.
That relates to another mistake, right?
Yes, putting all your eggs in one basket. Never, ever invest all your savings in just one single company's stock, no matter how much you love that company.
Even if it's your own company stock.
Especially then, maybe. If that one company hits hard times, your job and your life savings could be at risk simultaneously. Diversification is your best defense. Index funds solve this easily.
Okay, good point. And finally, something that seems small but adds up.
Fees. Ignoring investment fees is a quiet but catastrophic long-term mistake.
How big a deal can they be? Like 1% sounds tiny.
It sounds tiny, but compound interest works on fees too, just in reverse. That seemingly small 1% difference in annual fees over 30 or 40 years, it can literally erode tens, even hundreds of thousands of dollars from your potential growth.
Wow. So you need to look for low-cost options.
Always. That's another reason index funds and ETFs are so popular. They typically have very, very low expense ratios compared to actively managed funds.
Okay, this is all making a lot of sense. We've covered the why start early, the foundation, the accounts, the what to buy, the habits, the mistakes.
Covering a lot of ground.
Yeah, so let's tie it together with goals. How does the actual mix of investments change depending on when you'll need the money?
Right. This is where you align the risk you take with your time horizon. It's crucial.
So, short-term stuff. Money needed soon.
Anything you need in the next, say, 1 to 3 years. That money has absolutely no business being in the stock market. It needs to be kept completely safe and accessible.
Where?
High-yield savings accounts are perfect, maybe certificates of deposit, CDs, if you know you won't need it for a fixed term like 6 months or a year.
Can you quickly explain what a CD is?
Sure. A CD is basically you lending money to a bank for a fixed period, like 1 year, and they guarantee you a specific interest rate in return. Very safe, just not very flexible.
Got it. So savings or CDs for short-term, why not stocks?
Because the stock market is just too volatile in the short term. You simply cannot risk needing that money for, say, an apartment deposit in 18 months, only to find the market has dropped 20%.
Okay. What about medium-term goals, like that house down payment in, say, 5 to 10 years?
Here, you can start to take on a little more risk, but still cautiously. You might consider a blend of investments.
Like what kind of blend?
Maybe something like 60% stocks and 40% bonds, or perhaps 70-30 stocks to bonds. Bonds are generally less volatile than stocks and act like a shock absorber. They help protect your principal as you get closer to needing the money.
So dialing back the risk compared to long-term money.
Exactly. And then finally, the long-term bucket. This is the retirement money we've mostly been talking about, stuff that's 10, 20, 30, 40 years away.
What's the strategy there?
For money that far out, you can and generally should be more aggressive. That usually means a portfolio heavily weighted towards stocks.
Why be aggressive?
Because you have decades to ride out the inevitable market ups and downs. History shows that over long periods, stocks have provided the best returns and the best protection against inflation, even with the volatility along the way. Time smooths out the bumps.
This has been incredibly clear and I think really actionable. Let's just bring it all home. The core message for you listening, especially if you're in your 20s, it's that starting to invest now is about giving your money the amazing gift of time.
Yes.
It's the magic ingredient. It's not about needing a huge pile of cash to begin.
Absolutely. Your action plan can be really simple. Step 1, pick a good, low-cost brokerage, Vanguard, Fidelity, Schwab, Betterment, whatever fits you.
Step 2?
Start small. Seriously, $25 or $50 a month is a fantastic start. Just begin.
Step 3.
Automate it. Set up that recurring transfer so it happens without you thinking about it. Consistency is key.
And step 4.
Keep it simple inside the account. Choose a target date fund based on your retirement year, or a broad market index fund like an S&P 500 or total market fund. Don't overcomplicate it.
Perfect. And just to leave you with one final thought, something really provocative that just hammers home this power of compounding.
Yeah.
Imagine you managed to start with, say, $10,000, maybe from savings, maybe a small inheritance, whatever.
Okay.
And you contribute just $100 a month after that. And let's say you earn an average 8% return over 20 years. Not even 40 years, just 20.
Okay, $10 to there, 100 months, 8% for 20 years.
Your total balance after those 20 years would be over $101,000.
Wow, that's pretty good growth.
But here's the truly staggering part. Of that $101,000, how much do you think came from your actual contributions? The initial $10 plus the $100 a month.
Let's see, $100 a month for 20 years is $1,200 a year, times 20 is $24,000, plus the initial $10,000, so $34,000.
Exactly. Only $34,000 of that final amount came from money you actually put in.
So where did the rest come from?
The other two-thirds?
Yeah.
Over $67,500.
Yeah.
That was purely your money working for you, multiplying itself over time through compound interest.
That's incredible. The growth earned more than the contributions put in.
That's the power of starting early and letting time do the heavy lifting. That knowledge right there should hopefully be all the motivation you need to just start. Today. Even small.
Your future self, the one who's potentially $67,000 richer just because you set up that tiny automated transfer back in your 20s?
Yeah.
They're going to seriously thank you for tuning into this deep dive today.